Okay, good morning, ladies and gentlemen, and this is the live morning briefing with your host, Tony. So, one of the first things that I wanted to talk about today is that we do have the Fed interest rate decision coming out today. It is expected to remain the same, so for no change. The current target rate is 0% to 0.25%. So we are on that. We are at the upper limit at 0.25% at the moment for the Fed target range. But the title for today, of course, as we know, the Federal Reserve has not only one cut rates already and provided a lot of QE of buying bonds, or as well as such as mortgage securities, and also providing money to creating the Main Street lending program. What is left for the Fed to do? So what I want to do is just to do a review of what has happened so far, and just to kind of just go over what else the Fed can do. So I just wanted to bring up an article for you guys, just for us just to have a look at here. So this first article from Bloomberg, what I want to show you guys is what we can see here. So if I just so here, the Fed wants states to try banks before $500 billion credit line. Now, what the Fed did yesterday during session is they provided this amount to $500 billion in credit line to counties that have over 250,000 people or population of that. Now, central bank's guidance about the details of its $500 billion municipal lending facility, so local government lending facility, released late Monday. It says that states and local governments will need to provide a written certification that they tried to raise money elsewhere first, before they come to the Federal Reserve. So what the Fed is saying here, right, if you need money, then and you're not able to raise enough money yourself, and also via your local banks as well, then come to us as a last ditch effort, or a last ditch hope to gain money to support your county, or also your state. So this is what we're currently dealing with the Fed, right? So this is the only thing that they can do, is to, now they've done this, they still have their job to do of maintaining the economy, but a lot of the job has already been done. So this is the issue where it comes to, well, what do we really classify as a state or local government requiring the need for Federal Reserve help? Now, what they have said, the Fed, is that they would allow governments to issue more than $20 billion of debt over the last several weeks or so, as we can see there. So that's going to be quite a big amount. Now, what it also indicates here is that this is the first time the Fed has got into the municipal debt securities market, which is worth $3.9 trillion. So all of the $500 billion doesn't seem, it seems like it's not enough. But you've got to realize those are debts that counties and states always have. So those are going to be quite large. Now, what the Fed is putting in place for $500 billion is for when emergency money is needed, and when the Fed or the state or local government can't bring up cash. So this is why they're limiting it to 500 million and not chucking in $3.9 trillion, right? That would expand the Fed's balance sheet by a phenomenal amount, more than half of what the Fed balance sheet currently sits at. So you wouldn't expect to see the Fed going too crazy. That's for the first case scenario, is where one, local state governments are not relying on the Fed too much to borrow part of that $500 billion worth in municipal lending facility to ease their burden, and maybe you only see a little bit of it going on, but not too much. Now, on the flip side, the worst case scenario for this is where we see these local governments and states having to buy up, having to give a lot of, or acquire a lot of debt from the Federal Reserve, and this is going to be, and the $500 billion will not be enough, and so we could see ourselves we could see the US going towards the $3.9 trillion municipal debt market, and that could take the Fed's balance sheet way over than whatever it is, and at some point the Fed will have to sell those assets in return for whatever sort of interest rate that they set in the near future, and that will cause interest rates to slowly rise as there is less money being pumped into the economy by the Federal Reserve. Don't forget that. So the Federal Reserve controls the economy by the amount of QE and spending it provides to an economy, and also short-term interest rates as well. So those are the two key ways that the Federal Reserve or central bank can control interest rates. So that's one key thing to look out for, those two case scenarios there. Now, in reality, what I'm seeing is a middle path where we see potentially another higher amount, $500 billion being created, depending on how well these small businesses deal with the loss of revenue. And we'll go into SBAs a little bit later. But you've also got to think about people's mortgages. Banks that provide those mortgage loans, they're not going to be. One of the other things that I want to go into is that the CARES Act allows homeowners to skip paying their mortgages for up to a year without having to prove any sort of hardship. So this is one thing that's going to be quite hard for big banks like JP Morgan, Wells Fargo, where you have people that have these mortgages or big mortgages, and they can decide to not pay it for a year, which can severely damage a bank's liquidity, and that would require them to acquire more money from the overnight repo facilities or the repo facility. And then also the Main Street facility as well is also going to be increased quite a bit to keep those banks with extra funding. Okay, so next article that I wanted to go to before we have an in-depth look at the markets. So if I just bring this up here, so US GDP. This is going to be quite big today as to what we have. So the US GDP is set to show initial wave of coronavirus damage as the Fed vows continued aid. Now, what it shows here is that economists surveyed by Bloomberg estimate the Commerce Department will report that gross domestic product fell an annual rate of 3.8% or 3.8% in the first quarter, which would be the steepest drop since the depth of the Great Recession in early 2009. The data will highlight an economy already in deep recession, according to Goldman Sachs, as written in a research note. Now, the forecast figure that we have for US GDP quarter one is it sits at minus 4%, right? So the current area where US GDP sits at is at 2.1%. So we're expecting a decline by 5.9% to -4%. Now that's going to be quite big as a hit to the economy, and it already has been. No matter what if we get a figure lower than -4%, or if we do see a slightly smaller drop off compared to Goldman Sachs's forecast of the GDP falling by 3.8%. So that is as expected. Now, the reason being is we've seen China data where their GDP or their quarter GDP dropped to -6.8%, which was quite a significant move. And that was as expected. China's data was not going to look pretty, considering the draconic lockdown that they had placed themselves in. So for the US quarter one, we're going to expect the same sort of thing, where you're going to see damaging effects on the first quarter of US GDP. And that's, of course, as the coronavirus started to kick in, and then the Fed started to make decisions to cut rates and pump money in. Those actions take time to have an effect on an economy. So quarter one is going to look quite devastating. Market reaction wise, we'll talk about that a little bit later. Again, the key thing is quarter two, right? We want to see what the effect is of the Federal Reserve pumping in all of this money to an economy, okay? And all these rate cuts, what effect have they had, or will they have, in the second quarter GDP for the US? So of course, we have the FOMC meeting today after half an hour after the Fed rate cut. Not the Fed rate cut, after the Fed rate decision. Apologies. So after the Fed rate decision at 2 p.m. Eastern time today, then we have the FOMC press conference. And then we'll look for any sort of comments as to how long, first of all, will we have low interest rates, or how long will we remain near the zero or the low bound at 0% to 0.25%, and then when will we start to see a pickup when we start to hope for a pickup in interest rates and economic activity as well? What are their thoughts so far on what's happened in the US, and their thoughts on US GDP as well, coming out for the first quarter as well? And that's as expected. One of the things that I actually wanted to go through, right, is if we're talking about the Fed action and them not being able to do what else can they do? Let's have a comparison back to 2008, right? So if I just bring up the article here for you guys to look at. So, okay, during the 2008 financial crisis comparison, so the Fed slashed their key rate from 3.5% to 4.25%, and you saw one of the other things. So after the Fed had cut their rates to record lows in December 2016 as well, to near zero, then the focus was on providing liquidity as well and pumping in a lot of money, which is what they did. So the focus during that time, they were looking to stimulate the economy through open market operations and other measures that sustain the size of the Federal Reserve's balance sheet at a higher level, and that's according to what they said. Now, the market reaction to when we got to our low bound on the, if we had a look at US stocks on Dow Jones Industrial Average, it closed up by 359 points, or 4.2%. So there was optimism in the markets, and there was a confidence that was being brought back in, and a bit more of a risk-on attitude, as the Fed had cut rates and they said, right, we're going to pump in a lot of money to keep the economy afloat, to make sure that banks have enough money and that they're also restricted in how they lend that money out and to who, right? So you saw, so this is also another reaction as well. Prices for US government debt, so US bonds, they shot higher, of course, as more people chuck their money into safe haven assets, and to keep their money safe, they go into bonds and go into risk off mode. So we still had that there as well at the same time, which pushes yields lower. And the dollar fell to fresh 2.5 month low against the euro. Back in back in 2008, that we had this news coming out. So when we compare it to the current market situation, this is a little different. The reason being is that you've had a complete lockdown of economies globally, right? You don't have any fundamental data affecting an economy yet. So this is one of the quite similarities that we can see. One is that the Fed, they did cut rates in unscheduled meetings back in 2008 by quite a large amount, as they have done this year as well during the coronavirus pandemic outbreak. During the coronavirus pandemic, you've seen those huge cuts taken by the Fed. Remember, you did have Trump back in 2019 saying that the Fed is not doing enough to cut rates. Now, if you're looking at hindsight, you're probably thinking, well, thank God that the Fed didn't cut rates so quickly. Otherwise, where would we be left in the US? How much more firepower does the Federal Reserve have to keep the US economy afloat if they didn't have any space to cut rates? So other than cutting rates, the Fed have also, as I said, they've pumped in a load of money into the economy as well recently. So you're seeing those similarities. But here's the thing: that fundamental drop in US economic activity is going to look completely different to this year's economic activity of 2020 compared to 2008. This is an economic shock, right? Where the US GDP is going to be crippled. Back in 2008, people are unsure of when the US economy would recover, but they had more optimism. Even though capitalism did break down at that point, they had more optimism as to know with the Federal Reserve cuts, and also with the Federal Reserve pumping in money into the economy, that the economy would slowly come back to normal levels. Now, with the pandemic, that's completely different. As I said, we'll see what the reaction is. We'll see what the results are from Q2. That's what people are looking for, looking ahead to see what happens. If Q2 figures show that they're really negative, or worse than Q1, that's not going to be a positive sign for the markets. That's just there. But as I said, if we do get slightly better Q2 figures, then it shows that the economy is on the mend. Also, just one of the other things that I want to show you as well is also, I'll just go back to one of the other articles. Okay, so this is what I want to show you: the Federal Reserve's current balance sheet. Okay, this is where we sit at the moment. So if we look back at 2008, you can see that we got around $2 trillion on the Federal Reserve's balance sheet. But if we look at the trajectory or the speed in the pace of assets being taken under the wing by the Federal Reserve, we've reached nearly $7 trillion, or we're at $6.5 trillion. as of April 23rd. So this is probably going to be slightly higher today. But as I said, if we're looking at comparisons, the coronavirus locking down everything has had a much bigger effect on the Federal Reserve's balance sheet, right? They're having to buy up a lot more debt and provide through those through the loans that they provide to keep an economy afloat. So this is why we've seen this huge trajectory in the amount that the Federal Reserve has had to put under their total assets. Now, it doesn't. Now, this is a positive thing that they're taking on this. They're taking on this extra amount of money under their assets. But as I said, quarter two, we'll see. We'll look to see how. First of all, how quickly will the Federal Reserve balance sheet die down, or will it keep increasing? Some economists are saying that by the year end, we're looking at the Fed reaching $10 trillion on their Fed balance sheet. If we think about reality wise, okay, if we're currently sitting at $6.5 trillion and we haven't got through quarter two yet, and the US is still seeing huge numbers of unemployment rate and businesses and going to banks to borrow money and also local governments that would also be struggling to keep pumping money to the unemployed, then this has the probability of increasing even higher. But other than that, that's as expected, right? The Federal Reserve is going to increase the amount of total debt that they have underneath them. And as I said, at some point they'll have to sell those assets to slowly bring up interest rates as well at the same time. So that's what we're looking out for. Now, if we look at charts for the day, and we just have an idea of what we're dealing with. So the US dollar currently sitting at around 106 on the Japanese yen, or the USD JPY. We have seen some movement towards the downside every night that I've had a look at the dollar. We've always seen, of course, at the close of a session or in the morning of the Euro Open, we've seen that downside movement in the dollar, but that's on the intraday chart. But what we can see overall is this trajectory of where we're seeing a dollar weakness. And this is one of the reasons being is that there's less fear in the markets, okay? Because the dollar is king, and that's where everyone puts their money to keep their money safe. This is what we're currently seeing at the moment. So we're seeing less fear in the markets, okay? And there's also less volatility in the markets as well. So if we looked at the VIX, that currently sits at 32.9. So we've seen this huge amount of volatility where we saw dollar buying at the same time as well. And then what we also saw is that as fear started to deplete, then we're also seeing the same sort of effect. So this is a comparison. If I put it on a daily chart, actually I'll put it back on the hourly chart. That looks better. So if you can see this clearly, as volatility increases and fear increases and uncertainty increases, you see a rise in the value of the dollar. As I said, cash is king. And then as volatility peels off, then you see a depreciation in the value of the dollar, right? You see people becoming less fearful, and there's more of a risk-on appetite, as we can see in US futures. So if I just bring this out here we go. So we're still currently sitting around this level here at 2,880, which is, we'll see whether or not it does continue to push back up towards the upside. And we'll see what happens there. But at the moment, things are holding steady. This is just a reminder as to what's happened so far. in the story, just for you guys. But we've already discussed a lot of those points. One of the other things that I want to go back to now is small banks, okay, within the US. So if we have a look here. So this shows size of SBA loan approval statistics within the US so far. So this shows that what we can see is that a lot of the money that's being taken out via loan or on loan is 150K or lower, and that creates the majority of the loans being taken up through the SBA. So 74% of the people going out for a loan make up that count, and that total amount makes up to 17% of the total amount that the SBA has provided. Here's the issue with these SBAs. Okay, you've got these companies here, or these people or businesses or corporations taking up the significant amounts of the money from the SBA loans. Okay, making up over 23%. What does this do for small companies? You've also got to think, you've got big corporations that can handle the coronavirus to an extent, but small businesses and small to medium-sized businesses are the ones that matter the most. So one, just a little thing to end off with, one of the things that we could see is that we could see the small businesses going to small banks. And there's a movement away from the big banks. So you remember before the 2008 financial crisis, you had small banks and regional banks all over the place, right? And then after the 2008 crisis, all the bigger banks, JP Morgan, Wells Fargo, Bank of America, took over those regional banks, right? And took over all the debt that those regional banks had. Now, this is a different situation where you're seeing a lot of people applying for loans at the same time, and that money running out last week of $350 billion has now been there's now been an increase of to 400 or over 450 billion dollars altogether. So what this means is that if these big banks are nearing their lending capacity because they're dealing with a state or various regions as a whole, that means that puts a lot of pressure on them, leaving those small companies that are less significant and less important out to hang on the drying line, okay, or basically left out. That leaves them looking to other alternatives or having to wait to get money from those big banks, and then try to think up of some ways to survive during that period. So again, we may see a rise of small banks. So this is what is one of the other things that now small business loans that are given or have been accepted. Just one more final image that I wanted to show to you guys as well is here that majority of small businesses, what's happened here is that the US haven't received funds yet. So you've got over 80%. This is from a Business Insider graphic here. So from 80% are still waiting, and many have many not knowing where they are in the process, right, of receiving funds within the USA. 20% submitted applications said that they have been fully processed with funds deposited in the borrower's account. Here's the issue. As I said before, you have these big banks dealing with big regional state debts or loans, providing those loans to big companies and also small companies at the same time. They're more focused on the bigger companies, so bigger, smaller companies or near medium companies. And this is why you're seeing this huge gap between the approval rate. Because as I said, one, they're all coming in at the same time. And two, A lot of them are looking for not a lot of them are looking for a big amount of money altogether. So this is having a big effect. So again, may see the rise of small businesses. Okay, so that is your morning briefing. So for US GDP, just be careful of whether or not you're going to trade it. I'll leave that down to you. As I said, forward-looking Q2 is what a lot of economists and traders are looking at. How badly will Q2 look like, or will it look better? And also remember, the Fed interest rate decision is expected to remain the same at 0.25%, and then in that target range of 0% to 0.25%. Okay. All right. Thank you very much, and we'll catch you soon. All right. Goodbye.